Hello, everyone. I'm going to try to get through this intro without coughing.
You just put the
Too
hex
late.
on yourself.
Sorry. We have another wonderful guest, a good friend of ours coming up. We're going to touch on self-storage, but we're also going to touch on what investors really want in a return. And I'm talking about true investors that want to preserve capital right after this.
Not all you fake ones. And yes, I knew we were lying when I said
that. She's always stirring the pot, isn't she? Thank you, everyone, for joining us here on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, click on the carolinahardmoney.com and hit the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, and hit the bell. And sign up with Wednesdays with Wendy. Wendy donates 30 minutes per person on Wednesdays to talk anything about real estate. You can talk anything else you want, but you're wasting your time if you don't. Get on her calendar. She's usually booked a couple of months in advance.
Yep, love to have the opportunity to help you.
And that information is also over there in the chat. And while we're talking about the chat, there's a chat box on the right or underneath, depending on the platform that you're viewing us from. So if you have any questions or comments, please share. And without further ado,
I do.
Sharub, do we have any special guest graphics that we can bring up? Aren't we something? Okay, so after graduating with a degree in engineering and then an MBA from Ohio State University.
Yeah, the big O.
Paul Moore entered management development track at Ford Motor Company in Detroit. After being there 5 years, he and a partner established a staffing company, which they ended up scaling and sold to a publicly traded firm.
That's what I'm talking about.
And I like this after a brief retirement because
Doesn't
nobody
last,
retires. We always go to what's next.
You get refired rather than retired.
Paul started investing in real estate in the year 2000 because he's not scared of Y2K, but he did that in order to preserve his wealth. And that's really why we do it.
Yeah.
Paul completed over 85 real estate transactions and then started focusing in on commercial real estate in 2010.
Which we liked him.
An author of a couple of books in commercial real estate and is the managing partner of Wellings Capital, a private equity real estate firm. Paul is married with 4, I'm assuming, wonderful children.
It says children, but I bet they're all big. They're all grown up. He's
Paul,
saying no. We can see him over on the side. He's saying no, they're not.
Paul lives in Virginia. We met Paul several years ago at the Mid-Atlantic Investors. What is it? What was it
Summit?
called?
Mid-Atlantic Summit. I remember that.
It wasn't even the Mid-Atlantic Summit at the time, but it was the beginnings of the Mid-Atlantic Summit.
Which is an awesome event.
Years ago.
Yeah.
And we all think the same. And I know he's probably tired of sitting in the green room eating green M&Ms.
Yeah, we're gonna
bring
him out.
Welcome to the show, Paul.
Hey, it's really great to be here. You guys are high tech.
Yeah. We're bona fide.
Yeah.
You are bona fide.
We do this to kind of divert people from thinking that we know stuff.
That's brilliant. I love that strategy.
Thank you so very much.
Yeah. I mentioned to you earlier that we always talk about our mastermind groups that we're in and how people need to find a group of like-minded individuals
A
that
tribe.
they will help them raise their own bar. And so we talk about collective genius all the time.
Mm-hmm.
You gave a presentation last quarter that really hit home with me. And I wanted to just kind of touch on that. And it has to do with investors and real investors, people who have made money. And again, this all depends on where you are. If you're getting a late start, or if you had an early start and maybe, let's say you didn't invest wisely and you had to, start back over again.
You didn't mention that in my bio.
It
Yeah, that
happens.
short retirement.
But what most people are doing, they're trying to preserve the capital that they have and still continue to get a decent return. You want to touch on that a little bit, what most true investors are looking for?
I think there's a difference between speculating and investing. And when I retired at the ripe old age of 34, I did not know the difference. I started speculating and I thought I'm a full-time investor now, but I was actually a full-time speculator. I was throwing money to the bottom of holes in the ground, thinking it would produce 100 times as much oil, and it produced zero. And I got my friends involved in that one. And also, I actually invested with somebody in your area in Charlotte. And they actually told me they were getting 3% a month returns. And that 3% return landed them in 158 years of jail time. And they still won't tell all 2,000 investors where they hid the money offshore. I don't get that. But anyway, it's been 20 years. And so anyway, but seriously, I was an entrepreneurial investor, which is really a speculator. Investing is when your principal is generally safe and you've got a chance to make a return. And, speculating is when your principal is not at all safe and you've got a chance to make a return. And I was definitely a speculator. I wanted to get the same thrill out of investing that I got from being an entrepreneur. Entrepreneurs typically chase shiny objects and they have a lot of fun and they're always in startup mode and it's exciting. But being an exciting investor can also mean being a broke investor.
Right.
Paul Samuelson was the first economist to win the Nobel Peace Prize from the United States. And Samuelson said that investing should be boring. He said it should be like watching paint dry or watching grass grow. He said, if you really want excitement, take $800 and go to Las Vegas.
Yep. I like the limit of $800.
Yeah, right.
It's funny. The last time I was in Las Vegas, I went to the slot machines, which obviously that's just guessing. I was up $20 and I went, I'm done.
Nice. Nice.
Because usually you lose, once you get up 20, you're done.
Yeah, that's about right.
So that was all my excitement.
Yeah.
But yeah, retaining your wealth is almost as difficult as building it in the first place. Because you're looking at things from a different lens, through a different lens, because you're in a different place. So you tend to do things that are a bit more risky. And I love that you call it a speculative investment, because that's really, really what you're doing. So what did you do to change that?
I became a boring investor.
So what's boring to you?
Well, that was the crux of my talk at Collective Genius. A boring investor, they're looking for true wealth. My wife was lamenting this morning. She goes, so what's our company worth? And how much cash do we have? Well, there's a big difference, because true wealth, I think, is having assets that generate cash flow. Warren Buffett said, if you don't learn to make money while you sleep, you'll have to work until you die. And so I think, but it can be a little boring. It's not cutting edge. It's not going out with, Elon Musk inventing the latest, greatest thing. It can be that, but those are the exceptions. And that's why there are books and biographies about these folks, because they built something, that was incredibly speculative that worked. But for the most of us, investing should more fall into the boring category. So, boring investors attain true wealth. They also enjoy real freedom.
Mm.
Uh, Gold miners in the 49 gold rush, and then in the 1880s and 90s gold rush in Alaska, very, very few of them broke even. They had a lot of excitement along the road. Very few even got there to the Alaska through the pass there in Alaska. I went and visited there about a year and a half ago, and we've all heard this, but I'm going to make the point anyway. The boring people in those gold rushes made the most money on average. And of course, that was the people that owned the hardware stores,
Mhm,
the
supplies.
logistics operation, the
Mhm.
the hotels. When in the North Dakota oil boom, when we lost about $1 million, $1.2 million, a bunch of friends and I flushing it to the bottom of a hole that didn't produce any oil, we went on to build a multifamily facility to house those oil workers, and we made millions of dollars
Mhm.
housing oil workers in just a handful of years. And so, but it's boring. It's a lot more boring to, house oil workers than drill for oil.
That's
Um,
right.
but boring investors avoid hidden costs. I mean, there's hidden costs when you're always in startup mode, like I was for years, chasing shiny objects. You're always learning, you're always trying, you're building, and it's like the airplane that, the jet that's designed with, I think it's 800 horsepower, but almost all that's used to get up to the normal altitude. When you're cruising, they use very little of that horsepower to cruise from LA to New York. But if you're always in that high burn rate, always going up to your elevation, if you do that continually, you're going to burn out. And there's a hidden cost for your family. You said I have 4 kids. I got 3 great kids and 1 other one. No, I'm just kidding. My 16-year-old, whenever she hears that, she loves to jump in front of the camera and say, "It's me. I'm the other one." Anyway,
That's too funny.
but boring investors investing boring assets. I mean, how can you be more boring than self-storage? Think about it. It's 4 pieces of sheet metal, a floor, and a door. Oh, and there's some rivets. But think about it. It's boring. Where's the value adds in self-storage? Well, there are some, but they're kind of boring. And it's really but that's the kind of thing that basically makes money. I had a podcast for years called How to Lose Money. And on that
Love
podcast,
that name.
we talked to people who lost money on their way to success and all the lessons they learned from it. The boring investors apply those lessons. They have a long view. Like Buffett said, my preferred hold time is forever. And they're basically the opposite of day traders.
Mhm.
Sure.
Yeah. I love it. I mean, I love the difference between speculation, because I talk to a lot of people, especially in real estate, are like, well, Jonathan, I'm just in growth mode right now. I need that 12 to 15% annualized return because I'm in growth mode. I'm like, well, that's short term or short sighted growth mode. You can compound interest in a relatively safe place that can still create growth. It just doesn't create the cash flow. So there's a difference. Would you agree with that, or what are your thoughts on that?
Yeah, I totally agree. It's, we have to, I think this is probably obvious to all of your listeners, but I was telling my 16-year-old daughter, I do have a underage daughter. She's 16. And last night she was asking me about investments. And she said, well, what about an 18% return or something like that? I said, well, when you're getting those high returns, you've got to factor in the risk of loss. I mean, complete this sentence. Low risk leads to low return. High risk leads to, and of course she's thinking high return, but it's a high return or total loss. And so you've got to factor that possibility in. So 18% times maybe 60% with the chance that you'll lose, 40% chance you'll lose it all, gets you right back to that 10 or 11% range. And so, yeah, I agree that most assets are either cash flowing or growing. There are exceptions. Our company thinks we've found some of those, but it's really hard to get both.
Well, we really like that self-storage arena too. We're hopping into it ourselves.
Oh, yeah.
And
I knew that.
really,
That's exciting.
we're really excited about that. I just did the due diligence walkthrough last weekend, and it's, it's not sexy. There's nothing sexy about it.
Right.
But it's so similar to just a plain old fix and flip deal. You see what needs to be repaired. You take care of those repairs. You can increase the rents, and it's all about marketing too. It's too simple.
Yeah, it really is simple.
And on the finance, I mean, we've always loved them on the finance side because they're, number one, they're pretty simple.
And we like to lend.
We like to say any moron can make money on self-storage.
And hopefully we'll be one of those morons.
If the SBA loves making loans on something, then it's a
Kind of dummy
pretty
proof.
good chance that it's a moneymaker.
Yeah, that's absolutely true.
They typically don't like making a loan on a business and a piece of real estate and then giving you cash out for extra expenses.
Yeah.
But they do.
That's kind of a no-brainer. So let's talk about your self-storage book. What's it called?
It's called Storing Up Profits.
Oh,
How
nice.
to capitalize on America's obsession with stuff by investing in self-storage.
That's awesome.
Sweet. I like that.
Hold it up again so people can see that, because
All
we
right.
really
It's
we want to
right
give
here.
them the opportunity to get a look at that. I like it.
Seriously. Yeah, thanks.
Yeah, that used to be my running joke about self-storage, is that we as Americans will not get rid of our stuff. We have a love affair with our stuff. And some of our stuff, which is typically worth about $500, is so important that we have to get a unit that is also heated and air conditioned, because we want to make sure that our stuff is comfortable in between the times that we go visit it.
Yeah.
I love it.
I had to take out a facility, a storage facility, just at one unit for my Airbnb stuff. And while I was signing up for it, there was a woman in the office that had been renting for 17 years.
Wow. 17.
One unit for 17 years. I asked her what was in there. Well, stuff my mama passed down to me that she doesn't want in her own house. So what are you going to do with that?
Wow. Yep. That's one of the reasons self-storage is so recession resistant. It's one
That's
of them.
right.
Yeah, for
That's
sure.
right. We really like it.
Well, as you're moving up the economic ladder, you tend to buy stuff, and
Mhm.
you don't get rid of the stuff that you have. You don't replace stuff. You just accumulate more. And then at some point, you're empty nesters, or maybe you're moving down the economic ladder. You don't want to get rid of that stuff. So you still need a place to put it. And
Yeah.
it's a beautiful thing. Now, let's talk about the value add piece.
Yeah.
Most of self-storage is really mom and pops. You see a lot of
52%.
REIT
Yeah.
type properties, but really the majority are smaller mom and pop operations, right?
Yeah, that's true. I mean, mom and pops have a bunch of characteristics. I list those early in the book. And one is the attitude, if you build it, they will come.
Mm-hmm.
Just, we don't need to advertise or market. And that was true for many years. The great news is a lot of the self-storage owners, mom and pops, they still believe that. And so they're leaving incredible upside on the table. They don't care because cap rates have compressed and doubled the value of their facilities in a short time. And they're just cash cows to them. They're big metal boxes that spit out money. They don't view them as a retail business and as a piece of real estate. And that's to our advantage, because when we acquire an asset like that, we can add those things, those value adds, like a showroom where you sell locks, boxes, tape, and scissors, and make upgrades and sell insurance, and where you can, basically you can take them through why they might want this end unit, or this, this upper level unit that, is away from ground level. There's all kinds of things we can do. Often they have extra acreage with them, 5 or 10 extra acres out back that you can expand on, or more easily right now, gravel them incrementally and add boat and RV storage and then turn that into pavement if it really works later. You can do marketing. You can, across the board pricing is something they don't do. Can you imagine? Excuse me, it's something they do. Can you imagine them thinking like a hotel or airline and pricing different on different days of the week or for different unit sizes depending on the demand and supply in the area? There's
That's
all
right.
kinds of things that can be done, all kinds of value adds. And if you let me, I'll take you through just one example of how powerful this can be.
Awesome.
Please. Yeah.
Let's just do something simple. Let's do something you can do the day after you buy a facility. Let's say you bought a facility in Kansas and you looked around and you said, "Oh, there's not much U-Haul in this area." So you contact U-Haul, you get a contract with them, you park some trucks out front, you don't spend any capital money up front at all, except maybe to buy a computer terminal just to do the U-Haul on. And let's say you can add between $1,000 and $5,000 a month in commission from U-Haul. Let's use $3,000 a month. Okay, so $3,000 a month, $36,000 a year. Now here's the formula. In residential real estate, we know that residential real estate's based on comps. But in commercial real estate, of course, the value is based on a formula. And that formula is the value equals the net operating income divided by the rate of return or the cap rate. And so with a constant cap rate, if we can increase the numerator, let's say $36,000 a year, that's the U-Haul, divide that by a cap rate of, let's just say, they're running 4 or 5% right now for self-storage. Let's say 6%, which is more conservative. In other words, higher number, higher cap rate, lower value. Okay, $36,000 divided by 6%, you just added $600,000 to the value of your facility.
Wow.
So if you bought the facility for $1 million, that's let's say $500,000 in equity, $500,000 in debt. You just added over 100% to the value of that equity. That $500,000 just became worth $1.1 million just by adding U-Haul. And there's a whole lot of other things you can do, including add a billboard, add a cell tower, a propane filling station, an ATM, charge insurance and late fees, add the point of sale items. You can raise rent by 10% and add, perhaps 25% to the value of your equity just from raising rent by 10%. And people don't leave. Think about it. If I had an apartment unit, I was leasing you for $1,000 a month in Charlotte, and I raise the rent 10%, you might say, I'm going to leave rather than spend another $1,200 this year. But if I raise your $100 storage unit by 10%, you might say, that irritates me. But for an extra $10 a month, I'm just not going to move my stuff down the street. And that person ends up staying there 17 years through, maybe 34 rate increases, 2 a year.
That's right.
Think about this too. It catches inflation. If I'm renting out a large warehouse to Amazon or a factory, or, it might be 10 or 20 years, I'm locked in on the lease. With self-storage, I can raise the rates every month and capture a lot of that inflation we're seeing right now.
Yeah, where I am, this unit that I was telling you about that I'm renting started out at $45 a year and a half ago. Every 3 months, they send me an increase. Every 3 months. And every 3 months, I get mad and say, dang it, I'm going to pack up and move out of here. I'm still there. and I'm sitting at $75 a month.
Wow.
For the same thing that I rented for $45 a month a year and a half ago.
Okay, now multiply that by 1,000 units.
Ouch.
And basically, they just added $30,000 a month. That's $360,000 a year to their income because there's really no cost increase,
Right.
And what did I say? $360,000 a year. Divide that by a 6% cap rate. You've got a $6 million value increase just from raising rents and adding no capital expense.
That's just crazy.
So the beauty of forced appreciation.
And now this doesn't add as much value, but you can also add in management efficiencies by doing a lot of automated stuff with the gates, the keypads, the automated locks, people to be able to pay their payments online and be able to rent online, all that kind of stuff.
That's absolutely true.
Increase efficiencies as well.
Yeah, I mean, and we talked about the mom and pops. I mean, you touched on it, but most of them are under market rents, and a lot of them are substantially under market rents. And we were looking at one. It was
I know what you're going to say.
It was a 10 by 10 unit, and they were renting it for $5 a month.
What?
Yes. Yes.
So I'm just like, you see that in these mom and pop stuff, like, maybe it's like, Bill who lives down the street from me, I'm going to get him a deal or whatever the case may be. I don't know, in a small town, but like, yeah, we saw a 10 by 10 for $5 a month. That's
Nice.
amazing.
No, we didn't
I
know for
want
sure.
that.
It could have had a dirt floor. We don't know, but they
Yeah.
just failed to raise it.
We invested in a facility that had 80% occupancy, which isn't horrible in Grand Junction, Colorado, but it had 80% delinquency, and the owner could not get on top of this. Well, I mean, that's a real easy to fix the day you take over. I mean, look, you tell people pay, or we're putting a lock on it, and you're out.
Yeah.
And we have leverage for them to pay. Not only is there no eviction moratorium on self-storage like there was on
Right.
multifamily and single family, but in addition to that, we've got their stuff.
Yeah.
And
That's
so
right.
another facility we invested in Beeville, Texas, paid $2.4 million cash for. And within 3 months, just increasing the marketing, increasing rates to market levels, which are 25% higher, increasing occupancy, increasing management efficiencies, the value of this was appraised not at 2.4, which we paid for it. It was at 4.6.
Holy
And
cow,
so at
that's
that
awesome.
time, put financing on it of $2 million. Instead of that being like an 80% LTV, it was 43% of the new value, and
Wow.
then sold it for 4.6 million a year later, giving the investors, that only had $500,000 cash left in it, about a 5-to-1 return.
Wow.
Sweet.
We've got some comments on the side. We've got from Wendell Long. He says, I guess I'm one of those morons. He's anything but a moron. He's in self-storage. He actually taught me a lot about self-storage. He's a dear friend. And then we've got another one from David Smith. And
Yeah, it's on the just the cap rate. So the value of of a commercial property is based off of the net operating income, which is the gross income minus all of the expenditures, not including the debt. And then you divide that number by the cap rate, which is the rate of return that the market is looking for on a project like that in that area. So in his example, it was a 6 cap rate, which is a 6% rate of return on that purchase price.
is that clear as mud? And yes, it will be, that is recorded and will be out there forever and ever. Amen. Right?
Paul, we're running up on time. Thank you so much for joining us. But
Good stuff.
and don't go anywhere when we sign off. We want to properly thank you. But before we let you go, let's talk about your fund.
Wellings Capital.
Is it a evergreen? Can people get in and stay in, or is it more of a syndication type of a fund? Give us kind of an idea, kind of an overview.
Yeah, when we bailed on apartments after writing a book humbly titled "The Perfect Investment," we decided we couldn't compete with all these guys who were getting these insider deals from brokers that they'd known for decades, and so we finally decided to look at self-storage and mobile home parks that have a lot more mom and pop operators, a lot more potential upside, intrinsic value, but we didn't have a track record. We didn't have a team. We didn't have the technology. So we went to our investors and said, hey, should we be a due diligence partner for you? And they said we should. So we decided to work with these investors to put together portfolios of these, portfolios that have different asset types, geographies, operators, strategies, and properties. And so we do that. And so we put those together in a number of funds. People can join the fund. It's basically a syndication. And our goal is to find operators who you probably wouldn't find on your own. They might not advertise or promote well, like the guy who's getting like 23% returns on his mobile home parks, but he doesn't know how to do a webinar or use Zoom or get investors. So we bring, him like, $3 or $4 million at a time, and our investors get to enjoy those types of returns. So at any rate, that's what we do. You've got the website there, and also I have some free materials if it would help that understand cap rate, preferred return, and other information at the website.
Awesome. I'm sure David will take advantage of that. That's
Mhm.
awesome.
Absolutely. We'll have that in the chat so people can easily click on to your website.
Yes.
Excellent. Thank you so much, Paul.
Good stuff.
Thank you.
Great content. I know everyone will enjoy it. And since it's recorded, they'll continue to enjoy it.
Can people
Fantastic.
still get onto your podcast? I don't think you're doing it anymore. How to Lose Money?
You know, we stopped the podcast a year ago. We found 238 ways to lose money, and we were just tired. And,
Because I was going to say we could be 239.
I thought you were on there, Wendy, 4 years
I
ago.
could.
Anyway, no, the podcast is still available.
was.
All 238 painful episodes are on Apple, iTunes, Stitcher, etc. And you can access those through my website as well.
Yeah, that's great information. Learn from other people's mistakes.
Yep.
Exactly. All right, folks. Thank you guys so much for joining us.
Thank you, Paul.
This is the Real Estate Investor Show. Real estate for hard money. Or wait a minute. Yeah, hard money for real estate investors. This is only like our 200 and some odd episode. I still can't get the name right. We are Carolina Hard Money, Carolina Capital Management. If you are interested in borrowing money, please go to carolinahardmoney.com and click on the Apply Now tab. If you are a passive investor looking for passive investment,
And he's reading this, folks. He has a teleprompter.
I can't read, I can't spell.
Anyway,
By the way, I can't count either.
don't
So,
forget to.
hit the accredited investor tab, and don't forget to like, share, subscribe, hit the bell, sign up with Wednesdays with Wendy. Whew. Have a great day.
Thanks.
Bye.